How can a retailer generate nearly $270 billion in annual merchandise sales, yet depend so heavily on a fee that most customers pay only once a year? That is the paradox at the center of Costco. On the surface, Costco looks like a traditional retail giant. It operates enormous warehouses, moves products in huge volumes, and serves millions of shoppers across multiple countries. In fiscal year 2025, the company generated approximately $269.9 billion in merchandise sales. That number is so large that the obvious conclusion seems unavoidable. Costco must make most of its profit by buying products cheaply, adding a markup, and selling them at scale. That is how most people understand retail. The more products a company sells, and the more profit it earns on each product, the more successful the business becomes. But Costco does not operate like a typical retailer. Its gross margin on merchandise sales was only about 11.1% in fiscal year 2025. That is unusually low for a business with such enormous revenue. Costco deliberately keeps prices close to cost, limits the number of products it carries, and avoids pushing margins as high as many competitors might. Yet the company remains consistently profitable. The key clue appears in a much smaller number. During the same year, Costco collected approximately $5.3 billion in membership fees. That figure represented less than 2% of total revenue. But when compared with Costco's operating profit of roughly $10.4 billion, the importance of those fees becomes much harder to ignore. A relatively small stream of membership revenue was equivalent to more than half of the company's operating profit. This does not mean Costco earns nothing from selling merchandise. Its retail operations still need to cover costs, support warehouses, pay employees, manage inventory, and generate positive operating results. But it does suggest that the products on Costco's shelves may serve a more complicated purpose than simply producing profit at the checkout counter. The company has created a system in which millions of customers pay before they begin shopping. They pay for the right to enter most of Costco's warehouses, access its pricing, and participate in the wider ecosystem of products and services. By the end of fiscal year 2025, Costco had approximately 81 million paid members and more than 145 million cardholders worldwide. Even more important, more than 92% of members in the United States and Canada renewed their memberships. Those customers were not simply returning to buy another product. They were renewing their relationship with the company itself. That creates a deeper question. If Costco keeps merchandise margins unusually low, and if membership fees contribute so heavily to profit, then what is the real function of the retail business? Why does Costco need to sell such an enormous volume of products if the most reliable source of profit comes from the people who pay for access? To answer that, we first need to understand why customers are willing to pay Costco before they buy anything at all. That annual payment changes the relationship between Costco and its customers long before a single product is placed into a shopping cart. In most retail businesses, the first transaction begins when a customer decides to buy something. Revenue depends on convincing people to visit a store, compare prices, and complete a purchase. Costco reverses that sequence. Before most customers can access its warehouses, they first become members. In the United States, the standard Gold Star and business memberships currently cost $65 per year. Customers who choose the executive membership pay a higher annual fee in exchange for additional benefits, including a 2% reward on eligible purchases, subject to program limits. This changes the economics of the customer relationship. Instead of relying entirely on individual shopping trips, Costco begins with a recurring commitment. Membership fees are collected in advance and then recognized gradually over the life of the membership, creating a predictable stream of revenue that is much less dependent on seasonal demand or daily fluctuations in consumer spending. But collecting a membership fee creates a different challenge. Customers now expect that fee to pay for itself. Every visit to a Costco warehouse has to reinforce the feeling that becoming a member was the right decision. That expectation influences nearly every operating choice the company makes. Unlike many supermarkets or discount chains, Costco deliberately carries a relatively limited assortment of products. Instead of offering tens of thousands of different items, it focuses on a much smaller selection. Concentrating demand on fewer products allows Costco to purchase larger quantities from suppliers, increasing its negotiating power while simplifying inventory management. The company also avoids frequent promotional pricing designed to attract short-term traffic. Instead, it aims to offer consistently competitive prices throughout the year. This philosophy requires discipline. When customers believe they are already receiving one of the best available prices, they spend less time waiting for discounts and more time trusting the value proposition itself. That trust becomes especially important because Costco is asking customers to renew their memberships every year. The numbers suggest that many do. By the end of fiscal year 2025, Costco reported approximately 81 million paid members worldwide, representing more than 145 million cardholders. Even more remarkably, membership renewal rates reached approximately 92.3% in the United States and Canada, while the worldwide renewal rate approached 90%. Those renewal rates are unusually high for any subscription-based business. They suggest that members continue finding enough value to justify paying again year after year. Costco reinforces that value beyond everyday merchandise. Its Kirkland's signature private label products strengthen customer confidence in quality at competitive prices. Fuel stations, pharmacies, optical centers, travel services, food courts, and other member benefits increase the number of situations in which customers can recover more value than the cost of their annual membership. Viewed individually, each of these services appears to support the retail business. Viewed together, they accomplish something more important. They increase the likelihood that customers continue renewing their memberships, because the benefits accumulate across dozens of shopping occasions rather than a single purchase. This also explains why Costco measures success differently from many traditional retailers. Selling more products certainly matters. Growing warehouse traffic matters. Expanding internationally matters. But those achievements become significantly more valuable when they strengthen a customer relationship that extends well beyond today's shopping trip. The remaining question is how far Costco is willing to go to protect that relationship, even if doing so appears to limit the profit it earns on the products themselves. That long-term relationship explains why Costco makes one decision that often surprises both investors and competitors. The company intentionally refuses to maximize the profit on each product it sells. In most retail businesses, increasing gross margin is an obvious way to improve profitability. Raise prices by a small percentage across thousands of products, and operating profit usually increases. Costco follows a different discipline. For decades, the company has maintained internal limits on merchandise markups. Costco has consistently emphasized that maintaining compelling member value comes before maximizing merchandise margins. During earnings calls, management has repeatedly explained that the company evaluates pricing decisions through the lens of long-term member trust rather than short-term margin expansion. This is not simply a pricing strategy. It is an operating principle. Every time costs increase, Costco faces a choice. It can pass those higher costs directly to customers and improve short-term profitability, or it can absorb part of the increase, negotiate harder with suppliers, redesign packaging, improve logistics, or find operational efficiencies that allow prices to remain competitive. The company has consistently emphasized this philosophy in its earnings discussions with investors. Management has repeatedly stated that maintaining the trust of members is more important than maximizing margin on individual transactions. That philosophy becomes visible in the financial statements. In fiscal year 2025, Costco generated approximately $269.9 billion in merchandise sales. Those sales produced approximately $30.0 billion in gross profit, resulting in a gross margin of only about 11.1%. For many retailers, such a margin would appear uncomfortably low. Yet Costco continued producing healthy operating earnings while expanding revenue, opening new warehouses, and increasing its global membership base. Another detail makes this even more interesting. Membership fees increased to approximately $5.3 billion during fiscal year 2025, an increase of about 10% from the previous year. According to Costco, roughly 40% of that increase resulted from the membership fee adjustment that took effect in September 2024. The remaining growth primarily came from attracting more members and expanding the existing member base. Even the accounting treatment reflects the long-term nature of the model. Membership fees are not recognized immediately when customers pay them. Instead, they are recorded over the membership period as the company continues providing access and member benefits. At the end of fiscal year 2025, Costco still carried billions of dollars in deferred membership revenue that had already been collected but would be recognized gradually in future reporting periods. Meanwhile, the retail business continued growing. During the first 36 weeks of fiscal year 2026, merchandise sales increased again while net income also moved higher, demonstrating that the business could continue expanding without abandoning its pricing discipline. These numbers point toward an important shift in perspective. The unusually low merchandise margin is not evidence that Costco lacks pricing power. It is evidence that the company is choosing where it wants to earn its returns. Every decision to keep prices competitive reinforces the value members believe they receive. Every positive shopping experience makes annual renewal more likely. Every renewal strengthens a revenue stream that is both recurring and remarkably stable. At first glance, those appear to be separate parts of the business. One sells products, the other collects membership fees. But the financial results suggest they are not operating independently at all. They may actually be supporting each other in ways that completely change how Costco creates long-term competitive advantage. Looking at Costco through the lens of a traditional retailer makes many of its decisions seem unnecessarily restrictive. Why limit product selection when customers often ask for more variety? Why refuse to maximize profit on every item when demand is strong? Why continue protecting low prices even during periods of inflation and rising costs? Those questions all assume that the primary product Costco is trying to optimize is the merchandise sitting on its warehouse shelves. The evidence suggests something different. The merchandise is certainly important, but not because each product represents the company's greatest opportunity to earn profit. Its more important role is to continuously prove that membership is worth renewing. This changes how every part of the business fits together. The annual membership fee creates an incentive for customers to shop repeatedly instead of occasionally. More shopping trips increase purchasing volume. Larger purchasing volume strengthens Costco's negotiating position with suppliers. Better purchasing terms help preserve competitive prices. Competitive prices reinforce the value of membership. Higher perceived value encourages customers to renew. The cycle then begins again. Each element strengthens the next. Viewed separately, low prices, limited product selection, efficient supply chains, and membership renewals appear to be independent business decisions. Viewed together, they form a single economic system. Even Costco's balance sheet reflects parts of this system. At the end of fiscal year 2025, the company reported approximately $18.1 billion in merchandise inventories, while accounts payable exceeded $19.7 billion. That does not mean Costco never invests its own capital in inventory, but it does illustrate how rapid inventory turnover, purchasing scale, and supplier payment terms can reduce the amount of capital the company must commit before products are sold. Combined with membership fees that are collected before being recognized as revenue, the business benefits from multiple sources of financial stability that extend beyond individual retail transactions. This helps explain why competitors often struggle to copy Costco. Matching one product's price is relatively easy. Matching an entire economic system built on millions of renewing members is far more difficult. A competitor that relies primarily on merchandise margins cannot simply lower prices across thousands of products without putting significant pressure on profitability. Costco, however, can afford to maintain pricing discipline because member renewals continually reinforce the model that supports those prices. This also changes the meaning of scale. Many retailers become larger by opening more stores and selling more products. Costco certainly does both. But every additional member contributes something that extends beyond today's purchase. Each renewal strengthens recurring revenue. Each additional shopping trip increases purchasing efficiency. Each increase in purchasing efficiency helps preserve competitive pricing. Growth therefore improves not only sales volume, but also the entire operating system that supports long-term customer loyalty. From this perspective, the warehouses themselves begin to look different. They are not simply places where merchandise is exchanged for money. They are environments where customers repeatedly confirm that their membership continues delivering value. The products matter because they validate that decision every time a member walks through the door. Once that relationship becomes clear, the unusually low merchandise margins stop looking like a weakness. They begin to look like a deliberate investment in something far more durable than the profit generated by any individual transaction. Once all of these pieces are connected, the apparent contradiction inside Costco's business model begins to disappear. The company does not succeed despite its low merchandise margins. It succeeds because those low margins support something more valuable. The products inside Costco warehouses are essential. Without attractive merchandise, reliable quality, and consistently competitive prices, members would have little reason to renew year after year. But the products are not the final destination of the business model. They are the mechanism that continuously validates the annual membership. That distinction explains why Costco can report enormous merchandise revenue while maintaining relatively modest retail margins. Every pallet of groceries, every television, every package of paper towels, and every tank of gasoline contributes to a larger objective. Each purchase gives members another opportunity to confirm that paying for access continues to make financial sense. As long as that calculation remains positive in the customer's mind, the membership becomes increasingly valuable to both sides. For the customer, it represents ongoing savings and trusted value. For Costco, it creates recurring revenue, predictable cash flow, and an exceptionally loyal customer base. That relationship also produces a competitive advantage that extends well beyond pricing. A competitor can temporarily match Costco's prices on selected products. A competitor can copy warehouse layouts. A competitor can even introduce its own membership program. What is much harder to reproduce is the reinforcing cycle built over decades. Millions of renewing members increase purchasing volume. Greater purchasing volume strengthens supplier negotiations. Better purchasing terms help preserve low prices. Low prices reinforce member value. Higher perceived value encourages more renewals. The system improves because every part supports every other part. This is why Costco's financial performance cannot be understood simply by examining gross margins or merchandise sales. In isolation, those numbers describe transactions. They do not fully explain the economic relationship that keeps customers returning year after year. From that perspective, Costco is not merely selling products more efficiently than other retailers. It is monetizing long-term access to an ecosystem that customers repeatedly choose to remain part of. The annual membership fee is not an additional charge attached to the retail business. It is one of the central economic foundations that allows the retail business to operate the way it does. That is also why the company's unusually low merchandise margins are not evidence of a weak business model. They are evidence of disciplined capital allocation and strategic restraint. Costco consistently gives up opportunities to maximize immediate profit on individual products in order to strengthen a relationship that continues generating value over many years. Seen this way, the company is not simply asking customers to pay before they shop. It is asking them to invest in continued access to a system designed to reward them every time they return. And that may be the most important shift in perspective. Costco does not primarily create long-term profit by maximizing what it earns when a product leaves the shelf. It creates long-term profit by making membership so valuable that customers willingly pay before the next shopping trip even begins. The merchandise fills the warehouse. The membership powers the business.